Hey, what's up, everyone? Welcome back to another episode of the Entrepreneur's Playbook, where we help 7- and 8-figure business owners ignite their financial superpowers. Josh Bowerly here with Ron Parisi. Ron, how you doing this week?
Doing great. Appreciate the time, Josh. Look forward to another great episode.
Yeah, I think we're gonna go a little different route this time, right? You're gonna be the host, and I'll answer the questions.
We were just brainstorming, and we're thinking about here we are in mid-April, right? I think the one or big topic we get a lot of questions on from our clients is tax estimates and how they work. And even if you've been doing this for a long time, or you're new to the S Corp partnership and even C Corp stature, that these tax estimates become a new topic. So why don't you give us a rundown first on tax estimates? What are they? How do they work? Let's just talk about the IRS. We won't talk about states right now.
Sure.
How they work, timing, and then maybe we can, after that, we'll get into maybe why there's misconceptions around the tax estimates as well.
Yeah, so I think for people that spend most of their careers as employees, it's a little bit of a shock when you become an entrepreneur, because as an employee, you don't make estimated payments, of course, because they're being taken out of your paycheck every week or month or however often you get paid. Then you get to the world of entrepreneurship, and there's no one taking that out of your paycheck. Maybe you're an S Corp and pay yourself a salary, and they're taking some of it, but there's probably additional profits that you have to pay those taxes on. And the IRS is not really comfortable with saying, we'll put it on our tab. We'll get you at the end of the year, right? They don't like that money throughout the year. So they want you to make payments in 4 quarterly estimated payments. And it's interesting because to me, there's actually some strategy and some different ways you can go. And I know different tax preparers and tax professionals have different feelings on how to go about this. But one thing I think is surprising to people is the IRS requires you to make those payments based on what you owed the previous year, not necessarily what you're going to owe in the upcoming year, right? At least to avoid penalties. You can certainly make more, and that's part of the strategy. But basically, you have to make, assuming you're over, what is the income threshold at this point, 150,000? If you make over 150,000, then you have to pay 110% of what you owe the previous year in estimated taxes the next year. So if you had a tax liability of $100,000, then you'd have to make estimated payments totaling $110,000, right? It's my math right there. And you break those up into 4 equal payments. But there's also strategies out there where you can base it on, for people that have huge swings throughout the year, you can divide those up based on how your revenue actually comes in. I think we can ignore that for now. But a lot of people just say, okay, I want you to look at how much I owe, look at my income every single quarter and tell me how much I'm going to owe, and let's make that estimated payment. And then you can tell me if your thoughts are different. But my thought is, yes, let's take a look at that and let's figure out how much you're going to owe, but let's only actually pay in the minimum. And then let's have a separate tax account where we keep that maybe you're earning a little bit of interest on, or just keeps you flexible, because things can change drastically throughout the year, right? Like you can look really good for quarter 1 and quarter 2, and you paid those huge estimates, and then all of a sudden things crash in Q3 and Q4. Like we talked about last week, the advertising stops working for a quarter or 2. So to me, I would make what they call a safe harbor, make just enough to avoid those penalties, 110% of your tax liability the previous year, and then have a separate account where you have that money in that do not touch money of what you're projecting you're going to owe. What do you think? What are your thoughts?
Yeah, I was going to say, I completely agree with you, right? The first thing is, I think the biggest mistake you could do is paying the IRS too much money. Maybe that's the second one. The first one would be paying nothing, coming down to April 15th and not having the money to pay your taxes. That's number one. And we could get into a whole nother topic on that. But just say, as far as tax estimates are concerned, I agree with you wholeheartedly, right? Is the first thing that we need to do is pay your safe harbor, right? This way there's no underpayment penalties. Now with the increased interest rates, the IRS's interest rate goes up. I think it's it might be close to 8%. It's no joke to have these, you get hit by penalties and you also have the interest. But I often look at the temperament of my clients. Some clients just want that money out of their account and they just never want to be able to touch it. Other clients, like we put a little envelope account for their tax savings, knowing that, hey, if you've made more money than the previous year, you're going to owe money probably in April. And we put that in segregated funds in their accounts. And then some people, just say, I need every dollar I can to grow the business, and we'll figure it out in April. I guess it depends on the temperament of the client, but I agree with you. I like to make the minimums and then we segregate the funds and pay in April. So
Yeah, and I think where I used to see a lot of confusion with people is that first year they make that big jump where maybe they've made $100,000, $50,000 a year before, and all of a sudden they're jumping up to 400, 500, maybe $1 million in profits, and they're paranoid that they have to make these huge estimated payments. And again, just to reemphasize this, it's always based on what you owed the year before and what you're going to owe to avoid the penalties. Of course, you're going to owe more taxes when you make more money, but to avoid the penalties, what they call the safe harbor, it's always based on what you owe the year before. The year that you make that big jump, yes, be prepared, know that tax bill's coming, but you don't necessarily have to make those huge estimates to the IRS to make up for it.
yeah, no, I agree. And I think so just to summarize, right, there's 4 payments, right? Really, because everything's based on the previous year, by the time you have your taxes filed, say for 2023, here we are in 2024, you're going to know what your first, your second, your third, and your fourth payments are going to be. The safe harbor payments, because you know what your tax liability was for 23. Everything, like you said, is based off of 23. So your tax professional should be giving you vouchers or set up automatic payments for those 4 payments throughout the year, right? And those payments, again, remember April 15th, right? June 15th, September 15th, and January 15th of the following year. Talk a little about where we are right now, April 15th, and the double whammy, so everybody's familiar with it. I call the double whammy.
Yeah, no, that's a good point. And that definitely always takes clients by surprise the first time it happens. But your tax liability, what you owed for the previous year, is of course due on April 15th. But then, like you said, that first quarter estimate is also due on April 15th. So a lot of people, especially if, again, it's that first year, they've made a big jump, they can have a significant tax bill due and then a significant estimated payment due right at the same time. So this is why, once again, it's so important to have that professional that you're working with throughout the year so that you know this is coming. They can help plan for it accordingly. I'm sure you've had the same, but there's sometimes where you're talking to people where they're almost in tears because, yes, they were super successful. They had a great year, but they're not prepared for potentially $100,000 in tax hits or more when you're combining that tax bill and that first quarter estimate. So yeah, it's once again just another, you got to have the rear view and the forward looking combined together.
Yeah, I was going to say, I'm sure you've heard all the horror stories when I give talks to entrepreneurial groups, right? There's always like probably half the room talks about that first year, right? Where they go, because you got to remember the progressive rate. So maybe they're paying 12%, right? 22%, 24%. And then all of a sudden they have that big year and they're 37+% plus state. It's like, that's a big whammy they weren't expecting because of the progressive tax rates. Like you said, no surprises, always be prepared, always work with a professional through the year I can't stress that enough. But the last point I just want to make is, even though you're extending, right? If you don't have all your information, you don't have the consolidated 1099s from your investment accounts, or you're still working through your accounting, or you have some decisions you want to make on the retirement and you need to extend both your business and your personal returns, those estimates are still due. And so come April, you're going to have to estimate so this April 15th, you're going to have to estimate, if you're going to extend, you have to estimate what 23 is going to owe off that base of what you estimate. You got to make your first quarter payment by April 15th to avoid any kind of underpayment penalties and interest. I hear a lot of people, I don't have to worry about that because I'm extending. That extension is only the filing of the actual tax return. It's not the payments.
Yeah. I think that's super confusing for people because you think the extension and it's simply an extension to file. It's not an extension to pay. And people think, how could I possibly pay if I don't know what I owe? IRS says, too bad. Figure it out.
Yeah. As I say, I always think of the IRS as like the bookmaker who wants their money. They don't really make a lot of exceptions for folks, especially on the payment side. Any concluding comments, Josh?
No, I'd say one thing we have found, if you run into that situation, you didn't work with a tax professional and you get to the end of the year and you say, crap, I didn't make any estimated payments. Before the end of the year hits, I would talk to your tax professional. One thing they can do to try to make up for some of it, if you're an S Corp, try and withhold as much as possible on a year-end payroll. May not be able to make up for all of it, but it can at least take a chunk of those penalties away. And it's not something that I would use as, I'm not going to make estimated payments, I'm just going to do that. But if you got in that situation, it can help a little bit.
Yeah. Yeah, I think that's tax professionals' little trick up their sleeve, but that only goes so far because you have all reasonable comp issues and things like that. I don't really like to go down that route, but it's always a little trick that we have up our sleeves. Anyway, Josh, hey, always a pleasure being with you. Hopefully the audience pulled some stuff out and maybe learned something about tax estimates. And again, probably a non-sexy topic, but something that's super worthwhile paying attention to if you're a successful entrepreneur. So until next time, Josh, appreciate the time. Thanks, Sam.
Yep. See you next time.
All right. Thanks, Sam.